Good evening and a very warm welcome to everyone joining us today for this insightful webinar on Demystifying Derivatives. On behalf of Christ Deemed to be University, it's my pleasure to introduce our speaker, Dr. Sharavana Krishnan, Associate Professor at Christ Deemed to be University. He is an expert in finance and data analytics, specialization in ML with Python, business analytics, financial derivatives, and investment management. With a certification from top IIMs and several Scopus Index publications, he brings strong academic and industry experience. He has also led key initiatives such as a Center for Applied Finance and Investments, Wall Street Society, and CISI UK programs. Please join me in welcoming Dr. Sharavana Krishnan to lead today's session. We welcome you, sir.
Thank you. So, good evening everyone. Welcome to this online webinar. I am Dr. Sharavana Krishnan from Department of Commerce, Christ University. Let us get into the topic, demystifying derivatives. Hope all of you know how stock market is working. Let us understand how derivative is working in this Indian scenario and Indian context. What is derivatives? Derivative is a contract between two parties that derives its value price from an underlying asset. So, let us understand what is derivatives, and with an example we will understand how it works. So, let us take all of you to a cinema theatre. Let us understand that you are all going to a movie and it is your favorite movie, favorite hero movie, and you wanted to buy a ticket. And today is the first day the movie has released, and you get into the movie theatre and you see it is completely crowded, and you are not able to get a ticket of your favorite movie, favorite hero's movie. Now, what do you do? So, whether you buy at very higher price because the theatre is already selling it at higher price, because maybe it is a Bahubali, or it may be a movie like superstar movies, or whatever movie it may be. So, on the time of release, if there is a very big hype, the movie theatres also will rise or increase the prices of the tickets, and also the tickets will be available only in the black. So, whether you choose to buy the ticket from the black, or you try to avoid that and you want to go for later. So, let us take this particular scenario and discuss further. Now, when this movie ticket is not available and you want to still watch a movie, now let us give an example that if you take a letter from me, I will give a letter for for 500 rupees, 2 tickets you can get from the theatre. If that letter is being produced to, let us say that the hall, the theatre hall, in the ticket counter, and the ticket counter will give you 2 tickets for 500 rupees. So, you have to take a letter from me, and that letter has to be given to the counter, and they will give you 2 tickets for 500 rupees. Actual price, let us say it is 700 rupees. And now, what you do in this situation? Let us say 2 tickets is 700 rupees, but if you take a letter from me and go, you will get it for 500 rupees, which is actually an MRP. Now, whether you go and watch the movie, or you wanted to sell this particular ticket to someone else. So, let us say you assume that you sell this ticket to someone else, and ticket in the sense the letter, you sell this letter to someone else and take the money, and you prefer to watch this particular movie little later. So, now what is that here is being exchanged? The movie has something called price tag, that is the movie ticket price. It is because there is a hype for that particular movie, the ticket prices also keep on changing. After 1 week or after a 2 week, for the same movie the ticket price may be very less. But as of now, there are today, if you see, the movie price, movie ticket price is very high because of the hype. Now, let us understand the letter which I have given to you is called as instrument. The instrument which you carried or taken from me, this instrument has a value. So, this instrument does not have any value actually. This instrument derives a value from the actual price. So, actual price is what? The movie, and movie ticket is being sold for 500 rupees, but whereas the 700 rupees, whereas the ticket, the letter what you taken from me and submitted or given to the counter, they are ready to give you 2 tickets. instead of giving to the counter, what you did is you can sell that in the market or in the open, other public, general public, maybe your friends or somebody you are sold. Maybe you sold at 700 rupees or 1000 rupees, whereas I given only the letter. I did not say that this letter is 500 rupees or I did not say that this letter is 1000 rupees, but the value of this letter is derived based on the actual value of the movie ticket. So, hope you understand that it is just a product, it is a where instrument, where this instrument price is being derived based on the movie ticket pricing in the market. In real time also, the market is also working in the same way. So, let us now understand the definition, let us read this. So, derivatives is basically a contract between two parties. Now, what is a contract between these two parties? I as a person giving you a letter and you and me are getting into a contract, that letter is being taken by you and it derives the value. So, this particular letter has derived the value or the price from the underlying asset. So, what is underlying asset here? The real movie theater and movie tickets which is being sold in the counter or which is being sold in the market. So, currently the price of the ticket is 700 rupees for 2 tickets, whereas if you take my letter and go, you can sell it to others at 1000 rupees or even 1500 rupees. It depends on how good is that movie. If the movie is a super duper hit like Bahubali, even 1 week also you cannot get a ticket and you have to pay higher price for this particular ticket movie and get this ticket. So, it depends on the quality of the movie and the making of the movie, all other things are there. So, here in derivative for a stock or any other product, it also work in the same way. Now, hope all of you understood what is derivative and what is the meaning of derivative. So, the most common types of derivative, there are 4 types of derivative. Number 1 is futures, number 2 is forward, number 3 is option and number 4 is swaps. Let us understand one by one what is futures, what is forward, what is options and swaps. Here let us get into what is forward. So, before getting into what is forward, I also like to talk about in derivative there are important participants. There are 3 types of participant in derivative. They are number one they are called as hedger. We will also understand who is hedger and what is the role of hedger and why he is an important participant in the derivative. Number 2, apart from hedger, we also have somebody called as arbitrager. So, arbitrager, what is his work, what is his role, why he comes into the picture, that also we will be understanding. So, number 1 is hedger, number 2 is arbitrager and number 3 we have somebody called a speculator. So, let us also understand who is a speculator by taking into an example. Now, let us get into what is forward market or forward contracts. What is forward contracts? So, forward contracts are basically again between 2 parties. Let us say the same example of movie ticket. Now, I am giving a letter and this this letter is valid only for let us say 1 day or let us say only for 2 days or let us say valid only for 1 week. That means, I am designing this particular letter or I am designing this particular contract between that you and me, that this letter is valid only for this 1 week or this 2 days or 3 days or whatever the time duration may be, and letter has some rules and regulation that this letter has to be produced in the counter or you can also sell it to anybody. So, if you are selling to anybody, I am not going to take any of your profit, but however, it is up to you how you want to deal with this particular letter. So, this letter is called as financial instrument in this place and this is called as a derivative. Now, forward contract is one type of derivative product. How it works is, again you and me getting into a contract where I am not telling anything specific in the sense this particular letter is not standardized. It is not like everywhere the same kind of letter you will get, and it is just you and me, we are getting into this particular contract and it has a different customization is possible in this. So, when this kind of things are applicable in this particular contract, then we call this as forward contract. So, again we will now get into the meaning or definition of forward contract. So, the forward contract is a private agreement. So, the name itself says it is a private agreement between two parties to buy or sell an asset at a specified price on a future date. So, it's a private agreement because you and me are getting into this particular contract and it is customizable. That is why this is called as private contract. Unlike standardized future contract. So, we will understand what is future contract. Forward contracts are customizable. So, here we are customizing. I can give this particular letter for 2 days, I can give this letters valid only for 1 day or even for 1 hour, whatever it is. And it is negotiated over the counter because you are going to the counter and you can exchange, or you can directly meet your friend and you can sell that particular letter to somebody else. So, that is why it is called as over the counter, and allowing parties to tailor terms such as delivery date. So, I can also tell, for example, delivery date, in the sense you give the letter and you can take the ticket from the counter or anybody at any time. So, let us say if the validity is only 1 month or 1 week, then within that 1 week you have to go give the letter and you have to take the tickets. And quantity. So, in this letter has only 2 tickets. So, these are the things are specified in this particular contract. So, number one, understanding what is forward contract is very important to understand that it is a private agreement. So, it is customizable. Now, let us understand what is future contracts. So, futures are a standardized legal contract obligating two parties buy or sell an asset at a predetermined price or a specific future date. So, now how these futures are working, let us take with an example. Before getting into example, I just wanted to tell what are the instruments are in India dealt with derivatives. So, before getting into future, this is very important for us to understand. So, let me just write in here. So, what are the products or what are the instruments are available for in India in derivative market. So, number one, we have something called equity, which is also called as stock market. So, equity derivatives are there. So, number one, we have very famous and very popular equity derivatives are there. And number two, we have something called commodity derivatives. Again the second popular. So, commodity means we have gold, we have silver and many more, we will discuss a little later about that. And the third one, we have forex, that is foreign currencies. In India we have NSE FX, which trades US dollar, then yen, then euro and pounds. So, these are the dollars or these are the currencies, sorry, these are the currencies is being traded in NSE FX, that is foreign exchange. So, again this is also derivative market. So, number one is equity, number two is commodity and number three is forex. And also we have interest rate futures. In India we have interest rate futures, whereas if you see in the western countries, even we have weather derivatives where people are trading in weather, and there are energy derivatives, even live cattle are being traded in derivative market in western countries, whereas in India still we are using this derivative market only for trading and speculation. So, let us understand about all that, but these are the four popular instrument in India. Number one is equity, where in equity we can use derivatives and commodity derivatives are available. Then forex is there, that is foreign currencies, and we have interest rate futures. These are the only four types of derivative available in India. Now, let us understand how futures are working in equity, then I will take you to the commodity. So, let me open a website called nseindia.com. So, this is a stock exchange, National Stock Exchange of India, and this particular stock exchange started in the year 1992 after Harshad Mehta scam, and maybe the history you can read about it, but let us now get into the derivatives. So, how derivative stocks are being selected. In National Stock Exchange, almost around 3000 plus stocks are being listed, but not all the 3000 stocks are in derivatives. Derivative has some rules or guidelines from National Stock Exchange and SEBI. SEBI is the regulatory body which manages all this derivative market under the National Stock Exchange. So, the guidelines are very clear that the company, whichever the companies are taken into derivatives, they have a very high volume, almost last 6 months, and they will be having a good volatility, and it should not cross the percentage of volatility, it should not cross very high. If too volatile also, it is very risky, so they will remove from the derivative. So, there are a lot of rules that SEBI actually put and keep on managing or keep on looking into the particular stock. So, that is how there are companies is being selected to the derivatives. Now, let us take a very popular company, Tata Motors. So, Tata Motors, you can see in Tata Motors is their equity stock. Okay, let me take Adani Enterprises instead of Tata. So, Adani Enterprises is one of the a good company. Adani Enterprises, now what we see in the screen is currently the equity price, that is cash market. Now, the price of this particular stock is currently trading at 2313.90, that is today's closing price. Now, how in derivative it is working? Let us click on this tab called derivative, Adani Enterprises, and let me select stock futures. So, when I select stock futures, you will be able to see there are 3 contracts. Now, as we discussed, there are forward contracts and we have future contracts. Forward contracts are customizable, and I can tell whatever the terms and rules and regulation, whereas futures are not customizable, it is all standardized. That is why in National Stock Exchange or MCX or Forex, NSE FX or even interest rate future, these are all standardized. It is not that for individual to individual it will not change, it is a common. So, that is why here you can see there are 3 contracts, and we already we understood that derivative meaning itself, in derivative it is about a person, two party getting into a contract. So, here now we are talking about future contract where there are 3 companies, 3 months contracts are there. You can see number 1, it is December, January and February. So, this is all stock futures. So, now you can see, so already November month contract is expired. So, what is this expiry? Like how you have a medicine expiry, that particular medicine after that after that particular expiry we cannot use it. The same way in derivatives we always have an expiry. So, what is this expiry? Expiry is basically because it is a contract, every contract should have an expiry, correct. So, forward contract or future contract with expiry we will get in, but whereas future contracts are standardized, which is mentioned in the NSE, that is National Stock Exchange. Now, you can see here stock futures of Adani Enterprises, there are 3 months contracts are available. Number 1 is 30th December, 27th January and 24th February. So, we generally call this 30th December as the current month future contract, and 27th is the near month contract and 24th is the deep contract. So, these are the 3 types of contract we have. Now, we can also see the prices of this particular derivative contracts, which is expiring on 30 December. Why 30 December is an expiry? According to the SEBI, previously all last Thursday was the expiry date. Now, they changed because of the market dynamics and other things, they have changed to the Tuesday. Now, if you see the 30th December, it will be a Tuesday. So, you can check in this calendar, 30th December it will be a Tuesday, and if you go to 27th January it will be a Tuesday. So, every last Tuesday of a month it will be called as expiry of that particular contract. So, there is no difference, automatically the expiry has been fixed. Every last Tuesday will be the expiry. So, the first month contract is expiring on 30th December, whereas for the November month last Tuesday you can see it was yesterday, it is expired. That is why we have only the December month. So, yesterday was 25th Tuesday and it is expired, and today we have only the December month contract which is started from today onwards. So, it will expire on 30th December. Now, you can see the open price here and the high price here and the low price here and the last traded price. Now, how this particular value is being derived? Now, let me open another tab called nsindia.com, and here I will type Adani Enterprises again in equity, and you can see the equity price today it is down by 0.81 percentage. Today it is down by 0.81 percentage, that is almost 19 rupees the market price has been down. And go to the now derivative page. This is the derivative page, and you can see this is the price of today. So, today opened and you can see the percentage of change is 1%, which is almost 23 rupees. So, what is that we can understand from this? I already told the movie example, a theatre example, where that particular instrument, the derivative instrument, it is like a plain paper. How the value is derived? It is basically derived from the original price of the movie. The same concept applicable here also. How this price of derivative fallen by 1% is just because in the equity market, in the cash market, where the derivative is, where the equity price is fallen by 0.81 percentage, which is 19 rupees. Because of that, even in future it is fallen today. Future means future contracts. So, here it is 1% down, whereas here you can see it is 0.81 percentage. Nevertheless, it will not be always same, it will be slightly, there will be a difference, because it is all called as speculators. Speculators, now we will get into the concept of speculation. Why? Because speculators is, the job of a speculator is just buy and sell on during the market hours. So, what they do? They just speculate. Speculators means what? They expect or they rally that Adani Enterprises stocks will fall down today from the morning. That is why it has fallen 19 rupees. Or some people will have a hope that it will go up, then those people would have purchased. So, it depends on person to person, depends on the person, analysis to analysis. They will expect whether the price will go up or come down, and they will, based on that, they will buy and sell for the day. So, that is called a speculation. Now, the speculators decide this particular equity price, where they will keep purchasing and selling for the day, and you can see this particular buy quantity in the daytime during the market hours. Here there will be a buy quantity and sell quantity. So, there will be so many people purchasing and selling this particular stock in a day. So, what happens when they buy and sell here? The share price will keep changing here minute by minute, or whatever, it depends on the volume of this particular stock. So, you can see the traded volume today, it is almost 10.27 lakhs on equity share of Adani Enterprises being sold, not sold, bought and sold today, or sold and bought, whatever it is. So, this is the total quantity is being traded today of Adani Enterprises. Now, can you imagine how fast the share price should change? Now, because of that, will have an impact on this derivative price also. So, because there the prices keep changing, here also the price will keep changing, whatever their prices changes accordingly, or at least the relevant prices will change in this particular derivative market also. And there is a further research also can be done in this area. This is called as price discovery, whether it is because of futures the equity prices are changing, or spot market prices are changing, or because of spot market whether future prices are changing. So, we can keep doing lot of research on this area, but in theoretical and also in application wise, equity prices, whenever there is an increase in the actual cash market or equity price, even the future price also will increase. Whenever there is a fall, here also there will be a fall. That is how we can understand about the futures. Hope now you are clear with futures. Let us move on to options, next one. So, here there will be three expiry. You can see the next expiry price, And very interesting is, very important thing we have to understand here is, the percentage of change of each contract will be different, and you can see the previous close, I mean the price is also it is different. For the first contract, which is near month, which is December, it is 2324 is the price, and the next month contract is 2334. You can see 10 rupees difference is there, and the final, the last contract, that is 2350 is the price, and you can see the percentage wise almost everything is 1% is down, but the price there is a difference. Why there is a price difference? Because the expectation of this particular stock or the future contract, which is trading on 27th January, it is going to expire only on 27th January. So, that is why the price is little higher. So, people wants to trade on, I mean larger time frame, they can actually utilize this particular 27th January. So, to understand this better, we will get into commodity now. So, this is the equity future. Now, let us get into a commodity future. So, I will go to a website called mcxindia.com. So, here now let me take an instrument called future index and sorry future com, and I will select gold. So, now I will take gold. Now, let me click on the show. So, now you can see this is the MCX. MCX stands for Multi Commodity Exchange, which is again an Indian popular exchange on commodity, and this exchange timing is from morning 9 o'clock to night 11:30 it will be available, and you can buy and sell gold, silver and many other products. If you just click on this product, and you will be able to see there are so many products. So, they have bullion, they have base metal, they have energy, and they have agriculture products. So, now let us take an example of gold and how it is working in derivative, and why we have to understand this derivative as a common man. It is very interesting and very important for all of us to understand why we have to understand about derivative and how it is going to be useful for us. Now, let us take this gold. Now, look at this, the gold price of the future. So, 5th December which is going to expire, and 5th February. So, gold generally this is how the expiry date has been fixed, and 2nd April and 5th June. So, the 5 days, that is December end, I mean this actually November end it will be closing, the last 5 days is for delivery. So, gold can be taken as a delivery. What is delivery means? We can buy even physical gold through this MCX market. So, that is what the 5 days time is given. Now, let us understand. So, today it is a 10 grams gold price. So, the price is given, it is 1,25,750 today open, and currently it is trading by 1,25,900, and which is 0.54% today it is up. So, that is absolute changes is 675 rupees on gold, today it is gone up. Now, this is a future contract. Now, imagine a jewelry person who is having a jewelry, they keep purchasing gold and they will make jewelry and they will keep displaying that particular gold. Assume that, let us say today the gold price is I mean in the last recent past the gold price has actually increased very high, and do you think jewelry people will make profit or they will be making loss? Let us say they wanted to take an order from you, you wanted to buy a jeweler, or you wanted to give an order on jeweler, some design, specific design. Do you think they will keep inventory of gold in their showroom, and whenever you order it and they will actually do lesser price and they will give it to you? No. Whenever you order, on that particular day's price only they are giving. Even if it is lesser price, they are going to give at the lesser price only. Even if it is higher price, they are going to give at that same price. So, it depends on market situation. But any time the jewelry person, whoever is making the jewelry, they will not make any losses. Why? They can even enter into this particular futures contract. Now, the concept of hedging comes here. So, why they have to enter into this particular hedging? What is hedging? So, hedging is basically to protect their risk. So, whatever the risk may be, they can actually protect by entering into this particular futures contract. How they can protect? For example, let us say in the real time in the jewelry shop, if the gold prices keep on going up and they cannot keep on purchasing, let us say 1 kg of gold for manufacturing jewelry, because they have to even sell. So, let us say today the price is highest and they purchased that particular gold today, and later they wanted to sell it to the customer. Let us say when they purchased the price was higher, and when they are selling to the customer, the price, if it has fallen, it is a loss for them. So, how are they going to manage it? So, how they are going to manage is, let us say today the price is very high. So, what they will do is, they will get into the gold future contract, they will sell today at the highest price, because today is the highest price, let us assume, and today they will sell here in this future contract and they will hold this position. So, whenever that customer is purchasing the gold from them, at that time they will close this contract also. Let us say, assuming that the gold price has fallen after a week, the customer is going to purchase from the jewelry shop after a week, currently which is trading at the gold 1,25,900 rupees, which is, let us assume that it is going to fall to 1,24,500. So, almost 500 plus 900 rupees, that is 1,400 rupees, it is fallen. So, 1,400 rupees on 10 gram, let us say if it is 1 kg, and so much money they are saving or they are making a profit, because it is fallen. So, you are taken a sell position. Whenever you are taken a sell position, the price, if it falls down, then you are going to get a profit. So, in future contract of gold, because you are sold here where you are having a real time gold business and you are hedging that, so that whereas you lose the profit in your actual business, because when you bought it was higher price, and when you are selling it, the gold price has come down and you have to compensate there. So, that compensation can be made in this particular future contract. So, this is called as hedging. I can again tell this hedging in a simplest way. So, how things work in hedging is, let us say assume that you are a farmer and you produce rice. Let us say you are producing rice today, and when you produce today, I mean let us say you are actually sowing seed today, and after 3 months the rice will be ready, or after 6 months the rice will be ready, and today your field is ready for, I mean harvesting a sowing a crop or keeping a crop. So, let us say the price today of the rice is per kg 50 rupees. Now, let us say you do not know what will be the price of rice after 6 months, whether it is going to go up or whether it is going to go down. If it is going to go up, then you are happy, because the price of the rice is going to go up and you will be getting more money. Unfortunately, if the price falls down, what happens? You will be losing, even you will not get your investment what you actually made for the field. So, here again the commodity market comes and you can actually hedge your product of rice in this particular market. So, that is why we have products, and in agri we have other products also, and we also have another agriculture market itself called as NCDX, where you can get into hedging. So, which helps, I mean even actually when you are real time product, if you are losing money, here you can actually make a profit, so that you can compensate without any profit or loss. That is why derivative is basically a hedging instrument rather than a trading instrument. But whereas in India, unfortunately, people use it as a trading instrument rather than a hedging instrument. In Western countries and many other places, they utilize very well for as a hedging instrument. So, here many of us, we get into only trading, and I mean we lose money in the market. I have seen people actually losing lot of money in derivative trading. So, it is not advisable to trade on derivatives, rather when you actually grow up in your ladder, when you are working into bigger firms, maybe you can advise this kind of hedging things, and you can create hedging strategies for your company, which helps the company to increase their profit or maybe reduce their losses. So, that is how futures will work. So, this is called as future hedging. Now, let us get into the next level. So, hope all of you are clear with what is futures. So, these are the 4 types of instruments are there. We just checked commodity, which is called as MCX, and we also have another market called NCDX, that is National Commodity Derivative Exchange. In equity, we have National Stock Exchange and Bombay Stock Exchange. Whereas Forex we have NSE FX and MCX SX, and interest rate futures is being traded in NSE. So, these are the different types of markets where all the future contracts are standardized and it is not customizable, because future contracts are standardized. That is the important difference for futures and forwards. Whereas forwards are generally made by you and me on a table, it is like over the counter exchange, whereas futures are cannot be customizable, it is all standardized contract, which helps. Even actually the defaulter risk is also less, because the regulatory body is in between to make sure that your money is safe. Whereas in a forward contract you cannot say that money is safe, because there is nobody is watching or there is no regulatory body on forward contract. Now, very interesting topic that we will get into the next level, next types of derivative is called as options. What is options? Before getting into the the meaning of options, the name option itself says you have an option, you have a two option, you can choose any one of the option. That is what the meaning of option. So, what are the options we have? So, in option there are two types of option, one is called as call option, another one is called as put option. Now, we have to understand what is this call option, what is this put option, and how it works we will see. So, before getting into the meaning, let us understand a few terminologies of options by an example. So, in option again it is like it is a contract. So, we have a two party in this. So, there is one party called as buyer, another party is called as seller. In option generally the buyer is called as the holder of the option, the seller is called as the writer of the option. So, this is the two terminologies that we have to understand here. And another important concept here we have to understand is strike price or exercise price. I will also show you what is the strike price or exercise price in meanwhile. Another one is called as premium and expiry date. So, we already understood what is expiry date. Every contract, either it is future, forward, option, this expiry date is available for each of the assets. Then we also understand, buying we generally called as long. So, in people who trade in derivative, they call that, are you long on this stock, I am short on this stock, that is how they talk, or that is how it has been mentioned also. So, long means I am long, that is bullish, I am going to buy that particular stock, or I already bought that stock. Whereas short means I am selling that particular stock, that is how long and short, the meaning of long and short. Now, let us understand this very important section of call option. Now, let us understand agree on price now if option buyer wants he buys the asset later. So, let us not read all these things, let us get into the picture. So, there are two people, let us say we have a person A and person A and person B. Let us say person A has money and person B has house. Now, how they are going to get into a contract? What is the contract? That is what we are going to understand. So, what the contract is called as call option contract. How it works or what is the benefit of getting into this call option? Let us understand clearly here. Now, person A is having money and person B is having house. Now, person A is telling, I will buy your house, I will buy your house in the month of March. Let us say currently we are in the month of November, so let us say in December. So, in the month of March 2026, I will buy your house. Do you think person B will keep quiet? Why up to March I have to wait for you? There will be a question definitely. So, what she is telling, okay fine, I will wait up to March, but you have to pay me extra, that is the deal. If you pay me extra, then I will wait for it, otherwise I am not going to wait. Okay. But in the same time, what Mr. A is telling, Mr. A is also telling another condition that in March I will buy your house for 3,50,000 if I want. What he is telling, if I want then only I will buy. So, why? That is a contract, that is a speciality about this contract, that Mr. A has a right to decide whether to buy that house or not in the month of March. So, for that only Mrs. B or Miss B is getting a deal which is extra money she is getting. So, now this extra money is called as premium. I just told about what is premium, an option terminology. So, now what she is getting is premium 50,000, whereas understand Mr. A is having a right that he can decide whether he wants to buy this house or not in the month of March. He can decide, not now. For that he just have to pay this particular amount of premium, which is called as 50,000 in this case. So, 50,000 will be paid, and he can decide that in the month of March whether he wants to buy or not. So, for that even Miss B is ready and she agreed for it, and she will decide whether A is going to buy. She will say yes. If A is telling I do not want, she will say yes. So, she only can have the option of obliging to Mr. A, and she gets this 50,000 rupees. So, hope you understand this clearly. So, Mr. A will have the right, whereas Miss B will have only the obligation and get 50,000 rupees from Mr. A. Now, let us assume that if the house price rises to 4,10,000 in the month of March, assume that you have come to March now. Now, the price has gone to 4,10,000 rupees. Now, what Mr. A will do? Whereas currently the price is 3,50,000, currently in the sense in the month of December the price is 3,50,000, and in the month of March the price is 4,10,000. Now, what Mr. A will do, whether he wants to buy the house from her, because they already got into agreement at 3,50,000 rupees by paying 50,000 rupees premium. So, the total cost what Mr. A is going to spend is only 4 lakh rupees, whereas currently in the market the house price is 4,10,000 rupees. So, directly Mr. A is getting a profit of 10,000 rupees. So, he will exercise this contract in the month of March, that he will tell to Miss B that I will purchase your house at 3,50,000, and also I already paid you 50,000 rupees as a premium. So, total you can see in this PPT that 50,000 plus 3,50,000, total what Mr. A will be paying is 4 lakh rupees, whereas the house worth what he is receiving from Miss B is 4,10,000. So, directly he is getting a profit of 10,000 rupees. So, now you can see Mr. A is telling I am very glad that I bought this house. Now, I can buy it for buy a house worth of 4,10,000 just for only 3,50,000 rupees. So, that is what the signs of this option contract. So, that is the advantage. Now, so the girl or lady whoever got into this agreement, she sold the house for 3,50,000, but she also got 50,000 rupees extra premium. So, she got 4 lakh rupees, but she loses 10,000 rupees, whereas he gains 10,000 rupees. So, that is how this contract is being designed. So, now you understand, in the call option, very important one thing we have to remember is right to buy. So, call means it is right to buy. If it is a long call, then buying the right to buy. Again I will repeat, if it is a long call, then it is buying the right to buy. What is call meaning? Call meaning is right to buy, long call means buying the right to buy. We can also do a selling the call option, that is short call. Now, you can understand in this example itself there are two positions. Now, what Mr. A is doing is Mr. A purchased a call option, purchased means long, bought. So, buying a call option. So, now A's position is long call, whereas Miss B's position is short call. So, short call means she sold the call option to Mr. A. Why she sold? Because she is going to get that premium of 50,000 rupees, that is why she has sold. Whereas, Mr. A expecting the price will go up, that is why he bought this call option. Hope you understand this particular difference. So, here there are two parties, one party's position is buying the call option another party's position is selling the call option. So, here one person holds the call option, holder of the call option. So, Mr. A is the holder of the call option, Miss B is the seller of the call option. So, hope you understand this difference. Now, how this pay structure works in this? Now, you can see whenever a person who buys a call option, long call means right to buy, right to buy the underlying at a strike price. Now, what is the strike price in this example? So, we understood what is premium. Premium is 50,000, whereas the strike price is 3,50,000. 3,50,000 rupees is the strike price and the premium is 50,000 rupees. Now, can you imagine the strike price can be changing or strike price can be varying into different things? Yes or no? It can be different. Why? Because the strike price for this house is 3,50,000. Let us say if it is 3 BHK or 2 BHK or whatever the house may be, the strike price will be keep changing, depends on the market price. So, let us say this house is worth of 3,50,000, maybe some other house can be worth of 4 lakh rupees, or there can be some other house which is 5 lakh rupees, or depends on the time to time or size of this particular house. So, the strike price also can be varying. Now, you can also understand that 50,000 what she is paying is called as premium. The next important thing is, so strike price you understood, and what is the benefit? Benefit of a long call is when the house price keeps on going up, there will be a profit. When the house price is steadily falling, then there will be a loss, but it is limited only to the premium. So, Mr. A, he is the person who purchased this particular call option, he will not lose more than 50,000 whatever the circumstance may be. The house price can go up to 6 lakhs or the house price even can come to 1 lakh rupees. Then if it comes to 1 lakh rupees, what Mr. A will tell? No, Miss B, I am not purchasing your house, I will just pay only the 50,000 rupees. So, he is not going to purchase if the price is 1 lakh, because why he has to purchase a 1 lakh rupees house by paying 3,50,000? Definitely he will not purchase. So, he will buy that same 1 lakh rupees house in the market instead of purchasing from Miss B. So, here the loss is only limited to the premium, whereas when it comes to a short call, that is Miss B's position, she is having only the obligation, she has to only listen to Mr. A. So, her profit is limited to only the premium of 50,000, whereas the loss will be unlimited. How the loss is unlimited? Because if the house price keep on going up, let us say the house price is gone to 6 lakh rupees and she has to sell the house only for 3,50,000 rupees. So, that is her loss, but whereas the gain is limited only to 50,000. Now, you may ask, then who will get into this kind of contract? Very important that you will understand, when you can understand there are 3 types of movement. I will take it to after a few minutes after explaining this put option also. Now, let us understand the second concept of option, which is called as put option. So, again in put option, very important thing what you have to remember is right to sell. So, what do you mean by right to sell? So, again the same characters, Mr. A and Miss B. Again Mr. A is having money and Miss B is having house, but this time what Miss B is doing, she wants to sell her house, whereas in the previous case Mr. A wants to buy the house, whereas here Miss B wants to sell her house. So, she is deciding that she wants to sell her house after some time, that is in the month of March she wants to sell, but she is getting into a contract right now with Mr. A. Now, after getting into a contract, Mr. A is telling I am okay with this deal, but you pay me extra of 50,000. So, now Mr. A is getting 50,000 extra or the premium. Now, premium what he is getting is only 50,000, but whereas Miss A will have the rights, she can decide whether she wants to sell the house or not to sell in the month of March. Now, assume if the price goes up to increased to let us say 6 lakh rupees, do you think Miss B will sell this house? Definitely she will not sell, because the price has gone up. Why she has to sell into this contract where she got into only 3,50,000? Because the contract price is 3,50,000. So, definitely she will not sell, and she will sell this to in the market and she will sell, she will tell to Mr. A that I am not going to sell it to you and I will pay you the 50,000 premium, and she will be paying that to Mr. A, and Mr. A will take that 50,000 and she can sell this particular house instead of selling to Mr. A in the market at 6 lakh rupees, and she will get profit. But what is the condition of Mr. A? Mr. A will get only the 50,000 rupees and the contract is done. Whereas now if the house price fall, that is the scenario here. So, when the house price falls to let us say 2,90,000, now you see that the house price fallen to 2,90,000, but the contract price they got into is 3,50,000. So, if she sell the house in the market, she will be selling at a lesser price, but if she sell that to Mr. A, she can sell it at 3,50,000 because already they got into a contract. So, she will sell at 3,50,000 to Mr. A, and that is the agreement, that is the contract. So, Mr. A has to purchase this particular house from her at 3,50,000. So, Mr. A will pay 3,50,000, whereas the house price is only 2,90,000 and already he will be receiving 50,000. So, the total amount what he will be receiving is 2,90,000 plus 50,000, and that is 3,40,000, which is 10,000 rupees loss for Mr. A, whereas for Miss B it will be a 10,000 rupees profit. Hope you understand this. Now, how put option is working? So, the person whoever is purchased this particular long put will be having the unlimited profit and limited loss to the premium, whereas the person who sold this particular put option will be having limited profit and unlimited loss. So, in this our example, Miss B is having unlimited profit and limited loss only to the premium, whereas Mr. A will be having limited profit of premium of 50,000 and unlimited loss in this case. So, these are the two types of options. Now, just quickly we will understand how this is working in the equity market. So, already we discussed about Adani Enterprises. Now, I will take, instead of stock futures, let me take stock options, and I will also click on this option chain. Hope you can see this particular option chain. You can see there are two colors, and currently the Adani stock is trading at 2,313, and you can see 226, 223 not sorry 2,320, 2,326, 340, like that there are different prices, and you can see in the middle 2,326 is the current market price of this particular stock. So, which is called as at the money. Now, we can purchase, now this is the option price, this is a premium. So, to purchase at this strike price, the premium what we have to pay is 72 rupees. So, the left side is called as call option and the right side is called as put option, and the put option price is 72.40 and the call option price is 72.25. So, it depends on different strike prices, the prices will keep changing. So, the yellow color is called as in the money, because whenever the strike price is 2,326 and the prices are lesser, it is called as in the money in call option, whereas white color space is called as out the money. And in the put option side, white color space is called as out the money, and in the yellow color space is called as in the money. So, why it is called as in the money and out the money is because you are under the profit, that is why this particular is called as in the money. When you are out the money, because you are already under the loss, you expect the price to, let us say currently the price is at 2,326 and you bought a call option at 2,000, let us say 320. That means you are under the profit and the price of the underlying asset is also higher. But whereas if you buy at 2,340 and the current market price is 2,320, that means the current market price is lesser comparing to the strike price. That is why it is out the money, which is also called as loss for you. So, people whoever is buying a out the money call option will lose more faster. So, these are all details we have to take in a next session, that is again option chain analysis. So, now let us understand only the what is option and how it is working. So, this is the strike price and here is what the premium. So, in this particular screen you can see call option and put option, and option, this is what the signs behind the put option and call option. So, again I am just recap what is option. Option has two types of option, put option and call option, whereas call option is right to buy, whereas put option is right to sell. So, call option has again long call and short call, whereas put option also has long put and short put. A person who is buying the put option is called as long put, whereas the person who is selling the put option is called as short put. Hope you understand the difference between the call option and put option. And just recapping, so that we covered today the derivatives, most common types of derivative, futures, options and forwards. So, that is it from my side. Thank you. If you have any questions, you can ask in the chats, I will be able to answer that. If you have any questions, you can ask me. Okay. So, I given an example of house rate. Actually, house is not a derivative product. So, I showed you what are the derivative products. In India, we have only 3 types of derivatives, sorry 4 types of derivative I mentioned here. So, that is equity derivatives we have, commodity derivative we have, forex is there and interest futures are there. So, house is not a derivative product in India or not in even any other places also. So, we do not have a derivative product on house. So, house price we cannot check. I given an example as a house, only these 4 assets are there in the derivative market. So, if you have any other questions, you can ask me. Alright, long put and short put once more. Alright, fine. So, I will just take quickly because we are running out of time. Right. So, call option, please understand, in call option we have something called, I will write here. So, in call option, hope my screen is visible. Yeah. So, in call option we have something called right to buy. So, this is very important definition that you should understand. So, call option is right to buy, whereas put option is right to sell. Put option is right to sell. So, in this example if you see, the person who is purchasing a call option, okay, who is purchasing the call option has the right to decide whether he wants to purchase or not in the month of March. So, the contract period is 3 months. So, in the month of March he will decide whether he wants to purchase or not, whereas she will get only the money, she will get only the money, whereas Mr. A will get rights. So, for getting that rights he has to pay the premium of 50,000 rupees. So, he can decide whether to purchase this house in the month of March based on the current situation in the month of March. So, that is the right he is getting. So, that is why it is called as call option. He is buying the call option, he is the holder of the call option, whereas she is selling the call option, she is called as writer of the call option. Whereas in the put option side, it is right to sell, it is meaning of the put option is right to sell. Now, whereas the madam or Miss B, she is having the house and she wants to sell the house later date, which is in the month of March. So, she can decide whether she wants to sell now or later. So, here she is selling, whereas in the previous example it is buying. He wants to decide whether to want to buy or not. Whether she is selling here, she can decide whether she wants to sell or not in the month of March. So, that is why it is called as selling. Put option, put means right to sell, call option means it is right to buy. Hope you are able to understand this concept clearly now. Okay. So, what is swap? Swaps is basically again an agreement between two bodies. There are 3 types of popular 2 types of swaps. One is interest rate swap and currency swap. Generally bankers will get into this kind of swaps where they exchange currency. For example, in India we have currency which is traded in let us say INR and other country. So, somebody else wanted INR or we wants to buy US dollar. So, these kind of swaps will happen. So, giving something and taking something. So, that is called as interest rate swap, and currency swaps are very popular in banks, whereas that is not traded in the markets. Yeah, do changes in interest rate affect the prices of option? Yes. So there are, almost six, I mean, things which can actually change the product prices, or option prices. Interest rate can change, volatility can change, the asset price can change. All these things can affect the option prices. Definitely, it is correct. Any other question? All right. So thank you very much.
Thank you. Thank you all for your active participants. We extend a sincere gratitude to Dr. Saravana Krishnan for sharing such a valuable insights and making this section truly enriching. We also thank the organizer, faculties and participants for their support. Wishing everyone all the very best, and we hope you to see again. Thank you so much.
I would
Thank you,
like,
sir.
yeah, thank you. I would also like to tell everyone that online course we offer BCom, and there are other courses. In business perspective, we offer BCom, and if you are interested, you wanted to know more about BCom online program, you can actually browse the website, and it is very enriching experience you will be getting, because it is an online. It is ease of use of this particular degree, and the kind of sessions, what it is going to be like real time, and it is going to be a case study based and simulation based. You will be experiencing the same how offline classes is going to be, in the same way even online classes is going to be. And as a Christ University, we equipped with a lot of interesting technologies, where actually we can interact and make it more live and more enriching, and learning happens through online. So I request, if you are interested, and please go through and browse our website on online education. And BCom is a program which we launched recently, and we give the same quality of, a much better quality what it is that it's given in the offline classes. Thank you, and like to see you again.